Today we're going to cover the 14 most common IRA mistakes. Number 1 is contributing too little. On our next dollar roadmap at martinmoney.com, we recommend saving at least 15 to 25% of your gross annual income each year. Failing to do so could result in a lackluster retirement. In 2024, the maximum amount you can contribute to an IRA is $7,000 if you're under 50 years old. If you're 50 or older, that amount goes up to $8,000, and that amount is set to increase each year with inflation. So if you contributed $7,000 a year to an IRA for 30 years and had a realized rate of return of 10.67%, which is what the S&P 500 has done since it started, you'd have over $1.44 million. That's a lot of opportunity you could miss out on if you don't take advantage of IRAs. Number 2 is contributing too much to an IRA. Now, we just mentioned that in 2024, you can put up to $7,000 into an IRA if you're under 50 and $8,000 if you're 50 or older. If you contribute more than that, the IRS will penalize you 6% per year for every money that you leave the overage or excess contribution in the account. We have another video about excess IRA contributions. You can check that out if you'd like. Basically, you can avoid this 6% penalty by taking the money out of the account before you file your taxes, but you'll owe income tax on any earnings the account realized while the money was in the account, and you'll probably also have to pay a 10% early withdrawal penalty for those earnings. Number 3 is contributing to a Roth IRA instead. Traditional IRAs allow you to take a tax deduction at the time of contribution, and you pay tax on all your withdrawals like regular income. With a Roth IRA, on the other hand, you pay income tax before you make the contribution, and then all your earnings and withdrawals are tax-free. Now, the great thing about this is you get to choose when you pay tax on your contributions. So if your income's at a high level, you probably want to use a traditional IRA, so you can take the tax deduction while your income taxes are high. If your income is at a low level, you probably want to use a Roth and pay income tax while you're in a lower income tax bracket. That way, when you make the withdrawals, it's tax-free. Getting to choose when you pay tax creates an arbitrage opportunity with your income taxes. If you make a contribution to a Roth IRA when your income is high, you sacrifice the opportunity to take a tax deduction that would probably be more valuable over time. Again, we have another video about this, which we'll link below. Number 4 is not knowing the deductible limits. Traditional IRA contributions are normally eligible for a tax deduction, but the amount that's deductible depends on a lot of circumstances. For example, if your income is very high, you can be phased out of making a tax deduction. Also, whether or not you have access to an employer-sponsored plan at work or your spouse has access to a plan at work could impact your eligibility for the deduction. We've got those brackets and numbers listed on your screen, and you can make contributions to an IRA even if you don't get a deduction, but there's really not a good reason to unless you're using the backdoor Roth IRA strategy. Number 5 is not planning for required minimum distributions. RMDs will force you to remove money from your tax-deferred retirement accounts whenever you reach age 73 or 75, depending on the year you were born. If you need that income to live on, it's not a big deal. But if you don't need it, it creates a taxable event that you'd probably rather avoid. Since you know this day is coming, you can plan in advance and potentially reduce the tax liability of your RMDs. There are several ways to limit RMDs, which we have another video about, but the most common ones are Roth conversions and qualified charitable distributions. You could also potentially spend down your tax-deferred accounts in the years leading up to RMDs, but any one of these strategies will require advanced planning, so it's best to think ahead. Number 6 is forgetting to take RMDs. Now, the IRS is serious about required minimum distributions. If you fail to take an RMD, you'll owe a 25% penalty on the amount you were supposed to withdraw from the account for each and every year you fail to make the withdrawal. This is one of the stiffest penalties the IRS levies against retirement accounts. You'll have until December 31st of each year to make your RMD. The good news is you'll know how much your RMD is all year long because it's based on your IRA account balance on December 31st of the previous tax year. Number 7 is early distribution penalties. You must be 59.5 years old to make penalty-free withdrawals from an IRA account. If you make a withdrawal before age 59.5, you'll owe a 10% penalty and any income tax on the distribution. There are several ways to make early withdrawals without penalty. A few of those are 72T distributions or series of equal periodic payments. You could also do a Roth conversion ladder, and there are exceptions like a first-time home purchase, medical bills, tuition expenses, there are hardship exceptions. You could look into those. They might apply as well. Number 8 is fumbling or rollover. Now, there are a lot of good reasons for moving an employer-sponsored retirement plan into an IRA after you leave that employer. The main one being the amount of control you have over the account when you move it into an IRA. However, if you fumble the rollover process, it could be counted as a distribution, resulting in a huge tax liability. You can spare yourself this potential misery by doing a direct rollover. In a direct rollover, you'll reach out to your employer-sponsored plan's custodian, have them transfer the funds directly to your IRA custodian so they never come to you. It requires a bit of work, but it's much better than having a taxable distribution. If for some reason your employer-sponsored plan sends you a check, you'll have 60 days to get that money into your IRA, or the entire balance will count as a distribution and you'll owe income tax on the whole amount. Also, remember, you only get one rollover per year, so make it count. Number 9 is rolling company stock into an IRA. So like we just mentioned, there are a lot of good reasons to roll assets into an IRA. But you could cost yourself a significant tax benefit if you roll company stock from your employer directly into an IRA. And what I'm talking about is not taking advantage of net unrealized appreciation. So think of it this way. If you take that stock from your employer and you roll it directly into an IRA, when you take distributions from the IRA, you'll owe income tax on the whole amount of the distribution. That's how IRAs work. However, if you roll your employer's stock into a brokerage account instead, if you've owned it for more than 1 year, all your capital gains will be taxed at long-term capital gains rates, which are always lower than your income tax rates. Now, there are several tightly enforced rules about net unrealized appreciation. The first is you have 1 year to completely distribute all vested balances from your employer-sponsored plan, and you must distribute all assets from any other qualified plans you have with your employer, even if they don't have stock in them. The second is you have to make the distribution to your brokerage account in actual shares. You cannot liquidate the shares and then move the money into your brokerage account. Number 3 is you either have to completely sever service from your employer, you have to be age 59 and a half, you must be disabled, or you must be dead. I'd shoot for one of the first two. Number 10 is owning high growth or expensive investments. So using modern portfolio theory, investors set up a ratio of stock to bonds across all the accounts that they have. And the reason is certain asset classes are more beneficial to have in certain accounts than others. For example, it makes sense to have high growth assets inside of a Roth IRA because all of the earnings and withdrawals are completely tax-free. On the other hand, it's wise to have slower growing, more conservative assets in a traditional IRA or tax deferred account because all distributions will be taxable. So when you purchase investments for your IRA, be sure to buy the more conservative ones first in your traditional IRA and save the high growth stocks for your Roth. But do not adjust your asset allocation for this. Asset allocation first, asset location second. In other words, as you're buying bonds or fixed income assets, you'll start with those in your traditional IRA until you either run out of room in the traditional IRA or you've bought the ratio of bonds that you need. Then you'll begin buying stocks or buy them in the Roth. Finally, don't buy municipal bonds in your traditional IRA. It's like trying to take a second tax benefit that you can't get. Hold your municipal bonds in a taxable account where you can actually reap the federal tax benefit from the earnings. Number 11 is forgetting the Pro-Rata rule. We talked a little bit earlier about how backdoor Roth IRAs allow anyone at any income level to get money into a Roth IRA. The way you do that is you fund the Roth IRA with funds that are converted from a traditional or regular IRA. Ultimately, this is a taxable event, and the IRS evaluates all of your IRAs, both traditional and Roth, when it calculates tax for the conversion. And they do this on a proportional or pro-rata basis of traditional funds to Roth funds. For example, if you have $20,000 in a traditional IRA and $5,000 in a Roth, and you make a conversion, 80% of the conversion will be taxable because 80% of your IRA balance is still tax deferred. This could be a major hurdle to executing a backdoor Roth IRA. One potential way to avoid this is to roll your IRA into an employer-sponsored plan. This would reduce the taxable portion of your IRA to zero, meaning any conversions would be tax-free. Number 12 is fumbling a 72T distribution. A 72T distribution, or series of equal periodic payments, is basically a strategy that will allow you to remove funds from your IRA before you turn age 59 and a half, penalty-free. There are 3 different ways you can calculate those distributions, and once you start them, you must continue them until you reach age 59 and a half, or 5 years, whichever occurs later. That means if you start when you're 52, you'll have to keep it up until you're 59 and a half. If you start when you're age 57, you'll have to keep it up until you're age 62. Anytime we talk about these, we always recommend that you seek advice from a tax professional before you begin. The reason is if you mess them up, you can create a huge tax liability for yourself. If you can pay someone to keep you from botching that distribution, it'll be money well spent. Number 13 is leaving your IRA to your ex. If you haven't taken a look at your beneficiaries on your IRA in a while, you should probably do that. There are a lot of unfortunate stories of people who passed away and intended to leave their IRA to a loved one, but it actually went somewhere other than where they intended. Most commonly, this is an ex-spouse. Now, the mistake is easy to understand. They set up the IRA, they name some beneficiaries at the time the person they're married to, and years pass and they completely forget about it. Over time, the family situation changed, but they forgot to update the account. Now, divorce is the most common way we see this issue, but there are a lot of things that can happen to a family to cause it to change. Be sure you review your beneficiaries on an annual basis to make sure that your IRA actually goes to who you want it to go to when you leave this earth. I'll add that your custodian is going to give your IRA to whoever you name as the beneficiary on the account. It doesn't matter what your will says. Be sure your beneficiaries are named properly on your account. Number 14 is not liquidating an inherited IRA. Before 2019, if you inherited an IRA, you'd have your entire lifetime to liquidate the balance of the account. This actually produced a really great strategy called a stretch IRA that disappeared with the passage of the Secure Act in 2019. Now you have 10 years to completely liquidate the balance of your IRA, and if you fail to do that, you'll owe a 25% penalty on the balance for each and every year you fail to take the distribution. There are a few exceptions to this. If you're the spouse of the IRA owner, then really none of this applies to you. If you're less than 10 years younger than the benefactor when you inherit the account, the rules are different. And if you're the minor child of the benefactor, you aren't required to liquidate the account in 10 years, but you'll have to begin once you reach the age of majority. All right, anytime the IRS gets involved, things get complicated. IRAs are no exception. Occasionally, these quirks work in our favor, but many times it creates an opportunity for things to go awry. Be sure to keep these mistakes in mind as you manage your IRA over the years. We got lots more on our website at martinmoney.com and plenty on our channel. We'll also put links in the description below to different posts and videos that are related to this one. If you found this video helpful, we'd really appreciate a like and subscribe. It helps our channel to grow. As always, we're grateful for your interest. God bless and take care.